Hello and welcome back to All Things Money. I'm your host, David Blain. During the final segment of today's show, we're going to wrap up our discussion on luck and skill as it relates to investing. I've mentioned time and time again that, investing falls over, if you think of luck on one end of the continuum and skill on the other end, that luck, good fortune, probability factors play a large role in investing. And when designing your portfolio, when designing your investment strategies, you need to give an acknowledgement to that. So many people go into investing with an overconfidence in their own skills, and they end up losing a lot of money. And then, of course, it was bad luck. It wasn't their skill. But it's just very important that we understand this, that there's always an element of chance, and you should focus on the process and realize that even if you have the best process, we have a great investing process in our firm. We have construct well-diversified portfolios with very good investments. We do extremely well for our clients, but it doesn't always work out perfect. There are time periods when our portfolios don't do well as your neighbor, or your brother-in-law, and that's always painful when your brother-in-law is doing better than you. But they don't always work out perfect, but the process incorporates that into it. It takes that probability into account that, hey, maybe Europe will be having, a bad time for a year or two, or maybe Japan falls out of favor, or emerging markets, or whatever. It takes that into account in its process so that we always keep a high probability of success on our side. Because there's always in investing, there's always that hidden role that chance plays, and you cannot discount that. You cannot ignore it and think that you can outsmart the markets, all the time. When we look at investor behavior, we see that all the time, that people tend to look at the past performance, and even I do it. I have to guard against it. It's something that even professionals do, is you have to guard against looking at a historical return. Oh, well, this fund or this company or this investment, man, it's been doing so good. It's hard to ignore that. Someone was asking me the other day about Tesla Motors. They got some great cars out there. In the solar industry now, with the government subsidies in the solar industry, these guys are printing money in some of these solar companies, even though the company's not making any money. They're IPOing and making all sorts of money. And there's a real hard tendency. I think Tesla Motors was up, like 600% this year or something like that. It's very hard to ignore that and not to just want to jump on that bandwagon. Well, there's a very important concept in investing and in life in general called reversion to the mean. And reversion to the mean is anytime that luck is involved in a scenario, there's always reversion to the mean. When skill is involved, reversion to the mean plays a less part. And what do we mean by reversion to mean? It means that for outcomes that are far from average, that the next outcomes will probably be closer to the average. So for example, if you're rolling a dice as a pure game of chance, and you roll, 5 sixes in a row, 10 sixes in a row, reversion to the mean would indicate that the next time, the next roll of the dice would not be a 6. That on average, each of the sides of the dice will come up evenly, or a coin flip. If you flip 100 coins in a row, that although the probability of the next flip is exactly the same, something that has an average outcome, the average outcome of 50 coin flips is going to be an average of 50-50. So if you flip 50 coins in a row and they all come up heads, even though the probability of the next flip is 50-50, things that have a mean, a reversion of the mean, you expect the next one to be closer to that mean. And it's very important, especially in investing, whenever you see an investment that is way outside of the average return of other things, you should expect that somewhere along the way there's going to be some reversion to the mean. We see that with lucky streaks or hitting streaks. A batter in Major League Baseball, if they're batting 600 the first couple weeks of the season, that's just not realistic for that to continue forward. I mean, maybe there's somebody who's going to hit 600 for the whole season, but it's probably not very realistic that you'd expect some sort of reversion of the mean. Of course, the tricky part is, what's the mean? And is the mean stable or is it changing? Baseball, for example, are pitchers getting better? Is the 300 hitter the ultimate mark anymore? Are pitchers getting better? Are bats getting better? Is there something that is moving that average batting average around? In investing, we always say, the average long-term rate of return for stocks is X. Well, if you change the time period, it's different. As we continue to add one more year of data point, the average changes. The average life expectancy. If you had someone 100 years ago that lived to 80, they would be way above the mean, and you would say that that's not average. Well, the average continues to move. So when looking at things like reversion of the mean and luck and skill, you have to understand, is the average set, or could the average be changing? In something like roulette or a coin flip or something like that, the average is not going to change unless you corrupt the dice or the roulette wheel or something like that. In other things, the average can be changing, and so betting on reversion of the mean is not a sure thing either, unless you're absolutely positive you understand what the average of that particular thing that you're looking at. Well, that's getting a little bit technical there, but we want to wrap up here talking about luck and skill in investing. Just encourage you, don't overemphasize your skill in investing, and acknowledge the fact that good fortune plays a role in it, and design your processes around the probabilistic nature of investing, and guard yourself against bad fortune or bad luck that can do irrevocable harm to your portfolio. Okay, well, that's about all the time we have for today's show. I hope you've enjoyed this past couple of shows we've done on luck and investing. If you have any questions on that, please feel free to get in touch with us. So for All Things Money, I'm your host, David Blain, and we'll be back again next week at the same time.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.